There was no daylight between Powell day one and Powell day two. He basically affirmed the market's view that the Fed is going to cut rates in July, and maybe gave us a little hint about the need for the Federal Reserve to be aggressive. There's one bit of sound I want you to listen to. It's not the most exciting bit of sound, but maybe it gives us the main thing I was listening for is, well, how much in July and what comes next? So here's what he said when asked about the lessons from Europe and Japan.
You don't want to get behind the curve and let inflation drop well below 2%, because what happens is you get into this unhealthy dynamic potentially where lower expected inflation gets baked into interest rates, which means lower interest rates, which means less room for the central bank to react. And that becomes a self-reinforcing thing. We've seen it in Japan. We're now seeing it in Europe. And that's why we think it's so important that we defend our 2% inflation goal here in the United States.
So this idea, Scott, about not getting behind the curve speaks of a potentially more aggressive Federal Reserve when it comes to cutting interest rates. The market priced in for 3 rate cuts this year and about a 20% chance of a 50 in July. So that's the minority point of view that's out there. But remember, it was about 2 or 3 before Powell spoke yesterday, Scott.
You could even say, Steve, that some of the things that Powell himself mentioned, the chief worries, if you will, that he has about the economy don't necessarily just dissipate in a matter of 2 or 3 months, that those things stay with you for a while, thus needing perhaps more accommodative, if not aggressive policy.
I think that's right, Scott. The idea of the trade problem basically is not going to go away. It's an issue that's been out there for quite a while and will remain out there. And it's interesting that Powell's concern about the trade issue has escalated in the wake of a kind of, what do you want to call it, détente between China and the U.S. at the G20 meeting. So that's not helping him. What's interesting as well, Steve, is that the data this morning kind of went against Powell, right? You had inflation hotter than expected. You had very good jobless claims out this morning. So the idea of the economy weakening did not show up in this morning's data. In fact, it went the other way. And the reaction you had in the bond market, you had a little bit on the 10 in the last, half hour or 45 minutes of Powell's speech. But if you look at the 2-year from the morning, you had a spike up, not huge, but a rise in the 2-year yield. And otherwise, it remained flat during Powell's testimony.
You know, I lost count, Steve, of the number of times that Powell mentioned trade uncertainty between yesterday and today and the impact on business sentiment and business spending, et cetera. And I got to say, and maybe I'm on an island here, part of me wondered whether some of that was a passive-aggressive shot back at the White House that says, you know what, Mr. President, the problems, to the extent that you think there are any problems with the economy, are not because of anything that we've done. It's because of your trade policy and the tariffs, which have caused the uncertainty, which Powell himself cited so many times over the last 2 days. Right.
So, Scott, I think what you said is accurate, except for the solution to that is, then, Mr. President, we're going to cut rates the way you ask. So if he was really being aggressive, he wouldn't be out there telegraphing a rate cut. He can say all he wants about how the trade tension may be the result of actions by the president or the administration. But at the end of the day, it looks like the president's going to get what he wants, perhaps as a result of the uncertainty he's created through trade.
Yeah. In many ways, we wouldn't even be having this conversation if not for the trade policy itself and the tariffs that went into effect and have caused the CEO after CEO to come onto our air and say so.
Scott, I think that's right, but I think you also have to take seriously the underlying effects that the chairman is worried about. He does talk about and talks about a lot of deep concern about what's going to happen to capital spending in the country, the idea that companies are holding back. So he has some abiding concern about that, by the way, it's a pretty big shift from where he was a couple months ago. But now it looks like this concern about the effects of trade on the global economy, on the U.S. economy, on capital spending here is something that is now the driving force of Federal Reserve policy.